Hey, Dan Passarelli here. One question that I'm often asked is, how do I read these volatility charts? Well, volatility charts are very important to option traders, and they contain some useful information even if you're not an option trader. Take a look at this chart here. So up top, we have a chart of spiders, a regular stock chart, price chart. And immediately underneath it, we have a volatility chart. Now, there are a couple things to notice. The red line is the implied volatility. That's basically how cheap or expensive the options are, baking in expected future volatility moves. The blue line is historical volatility, and that's how volatile the underlying stock has been over the past X number of days. In this case, I used 21 closing days. So we look at three different things. First, we look to see if today's implied volatility is above or below today's historical volatility. If it's above, that's one indication that maybe options are somewhat expensive. Then we look to see if today's implied volatility is in the top half or bottom half of the 6-month range. In this case, it's in the top half. That's another indication options might be expensive. Step 3 is we simply forecast out what volatility may be in the future. Now, this seems a little tricky and daunting, but really all we're doing is looking to see what news is expected. Is earnings coming up if we're talking about an individual stock? Is the monthly unemployment coming up, or an FOMC meeting if we're talking about a broader index like SPY? And if we expect volatility to be high or expect volatility to be low, that'll affect our opinions on whether we should be buying or selling options at this implied volatility level. I hope that helps. This is Dan Passarelli of Market Taker Mentoring. Trade smart.